Is 2023 likely to be a good time for real estate investment trusts, also known as REITs? So on this video, I'm going to talk a bit about real estate investment trusts, also known as REITs, some of the positives and negatives of them. Before doing that, you can go over to adamfire.com, especially if you're a high net worth individual or an expat living overseas, and see how I've helped people probably like yourself in the past. Now, in terms of real estate investment trusts, basically it's an indirect way of getting access to real estate. So there are many types of real estate investment trusts. Some are diversified, just like stocks. You can buy stock market ETFs like the S&P 500, or you can buy individual stocks. Real estate investment trusts are similar. Some real estate investment trusts are listed on the stock market and some are private. But if they're privately owned real estate investment trusts, usually you have to be a certified high net wealth individual or have access to an advisor to get access to those investment opportunities. So basically, one of the reasons why people like real estate investment trusts is the long-term performance has been comparable to the S&P 500 and other public stock markets. But the correlations are about 60 to 65%, which in human terms means that basically, just because the stock market falls doesn't automatically mean REITs will fall, and vice versa. So for example, recently, after COVID, real estate investment trusts haven't done that well relative to stocks for fairly obvious reasons, right? Because more people are working from home. So that means commercial real estate, office buildings and so on aren't as popular as before. So that's an example. But likewise, there's been certain time periods like from 2000 until 2008 where real estate investment trusts beat the stock market. And there are other times when they both go up or down together. So a Vanguard study showed that if you have 10% in REITs over the long term, you can actually get a slightly better return with slightly lower volatility for this reason. So they can be attractive. However, certain real estate investment trusts have a lot of risks. So for example, if you go for a specialism or a niche real estate investment trust, there are certain risks. So right now in the UK, some of the mortgage related REITs are given a dividend yield of 13 or 14%. However, they're obviously very risky because interest rates are going up and it's a very niche area. And there have been other REITs, if they're going for a very specific area, they can go to zero. So basically, with real estate investment trusts, if you don't want loads and loads of risk, the best way is A, to hold it long term, and B, to be diversified. So for example, the iShares Global REITs is one example. It's not perfect because it's on the US stock market, which means non-Americans often have to pay 25%, dividend tax, but there are alternatives to that for non-Americans. That's an example of something which almost for sure won't go to zero because it's linked globally to many different types of public, companies. As a publicly available asset on the stock market. It's got an ISIN and so on. If you don't want loads of risk, you could go for something like that. If you just want a small punt, like with 1 or 2% of your portfolio, you might want to go for something specialized, but in which case you might want to speak to a lawyer or an advisor or whatever, so you can actually understand more about these things if you don't have the time to do the due diligence. Now, the question is, in 2023, are REITs likely to do well? Obviously, it's very hard to know for sure, but I suspect they could do well, or some REITs could do quite well. Because if you think about some of the trends that are happening, first of all, work from home is here to stay, but a slightly higher number of people now are going back to the office at least 2 or 3 days a week. And with energy bills going up in many parts of the West, more people might want to actually go to work for that reason as well, even though the cost of going to work is always going to be higher probably than working from home. In addition to that, certain types of REITs will be quite good in a recession. So for example, roadside retail, we're still going to be eating burgers and going to coffee shops during a recession. And also, even though the pandemic, people aren't talking about it as much, fewer people are using trains and so on, which means more people are using their cars for certain journeys, which means more people will use roadside retail, for example. And also the valuations are cheaper than some stock markets. Some REITs are still below where they were before the pandemic. So personally, I think REITs have a part to play in a portfolio, especially if you keep it down to 10 or 15%, but I would keep to diversified REITs if you can.